What's going on, everybody? Welcome back to another video here. I hope you guys are excited. We have an awesome video prepared here. We've just been through 2 days of Jerome Powell testifying before Congress, and we have a lot of Jerome Powell comments to go over here, guys. So he essentially had said, there was a quote that came out, and I watched it happen live, that he does expect there to be bank failures due to commercial real estate. We're going to break that down. But he also said that he doesn't necessarily believe we are that far away from basically the Fed feeling comfortable enough to start cutting interest rates. Now, I do not expect, and we'll talk about this too, especially on all the live streams we do every single day, I don't expect the Fed to come out and do these jumbo rate cuts to try and stimulate the economy again. There's a lot of intricate moving parts here that the Fed has to be very, very careful of. But without further ado, guys, I know it's been a while, so if you guys wouldn't mind hitting that like button down below, subscribing if you want more videos like this, and commenting down below if you guys do have any questions on anything. So let's get into kind of the daily chart of the S&P 500 here. I've got ES up here, which is just the S&P 500 futures. And as you guys can see from these October lows, we have just been on an absolute moon mission in the market. For a lot of you guys that are in the Swing Kings course with us, if you're wondering why it's been so incredibly easy to be calling out these 500 to 1,000, 2,000, 3,000% gains every single week, this is exactly why. And again, if you guys are interested, all of my education is 50% off right now. The link is down below. But the one thing I want you guys to pay attention here when we're looking at this market is a lot of these giant dips that we've seen have been immediately bought up. You can see this one right here. I mean, that's only half a percent here in the market, bought right back up. This one was about 1.63%. The very next day, we rocketed back to the upside. This was actually a day that I was able to capitalize on very much so here. This negative 1.39% day followed right back by a 1% green day here. All of these dips are being bought. Now, why is that? What's going on? What are larger investors talking about? That's a concept for another video and what we're going to be talking about on the live streams every single day. But what I do want you guys to understand, and the one thing that I want you to keep focus on over the next couple of weeks here, is that you got to look at the overall price action. We have a low, a high, a higher low, higher high, higher low, higher high, higher low. It just keeps continuing, and these dips keep getting bought. The moment that these dips stop getting bought back up and we see continued selling, that is going to be the time to start to take a step back. Now, let's get into what Powell has been saying. So the first thing that I want to talk about here is Powell says he's been caught by surprise by the bank failures and sharp inflation decline. Now, I don't necessarily think that that's the case. I don't think Powell, with all of the data and the research that him and his team are doing every single day, are really surprised by regional banks failing or necessarily the inflation decline. Now, we have seen some very significant inflation, year-over-year inflation decline over the basically last year and a half here. And for those of you guys that might be new to markets or new to finance, when people say that inflation is coming down, it doesn't mean that prices are coming down. The only thing that it means is that prices are still going up, but at a slower rate. Think about it like this. If you have an investment that is going up 10% per year, but now all of a sudden it's only going to go up 5% per year, well, your investment is still going to go up, but at a slower rate. That is how I want you guys to think about inflation, because that's exactly what this is. Now, let's talk a little bit about what Powell was saying with these regional banks here. This is the quote here. Powell expects there to be bank failures from CRE, which stands for commercial real estate. Now, why is this? Well, there's a couple of different reasons. These regional banks are the ones that are lending the most and holding these loans on commercial real estate properties. So when the values of these properties go down, it's very possible that these banks can take significant losses. Now, there's different sectors of the commercial real estate space. There's retail, there's office space, there's those big shopping centers that you guys see. The one that everybody is focusing in on right now is office space. Now, America, the United States, is one of, if not the only country that has kind of shifted to this hybrid environment where people are working from home part-time and coming into the office at other times, or they're just fully working from home. I know I have a lot of friends where I live in Boston that have jobs, but they never have to go into the office. Now, if you think about all of these people that no longer have to go into the office, well, these corporations no longer need these office buildings. So what do? They leave. And the people that are investing in these properties, these large real estate investors, are sort of the ones left holding the bag to try and figure out what to do with these properties. But at the end of the day, it's these regional banks. Now, when we come over here and think about what these losses are actually going to look like, the ailing office space market is headed for $1 trillion of losses. Billionaire and Starwood Capital CEO Barry Sternlicht said. If you guys don't know what Starwood Capital is, they're a very, very big player in the real estate space. Per Bloomberg, Sternlicht said at Global Alts Conference in Miami Beach that office properties, once a $3 trillion market, are worth about $1.8 trillion now. Now, you might be thinking, well, all right, there's a $1.2 trillion loss that these banks have already taken, and that might be why we've seen these banks failing. That's not necessarily the case. When you think about real estate in general, let's just think about residential real estate compared to another investment class or asset class like the stock market. What is transacting faster, the stock market or real estate? Well, it's obviously going to be the stock market because we can go in and out all the time. We have all of our derivatives that we have at our disposal in order to take advantage of. Home prices are more expensive than these single stocks out here. And you have to go through a little bit more and a lot more of an extended process in order to get the keys to a home. So when you think about residential real estate, the volumes are going to be slower, and you can basically label that as a less liquid market. And then when you go up the chain there too, to these residentials or these retail spaces, these office spaces with these buildings that are 30, 50, 100, 200, 300 million dollars, think about how few of these buildings are transacting on a year-to-year basis. And a lot of them haven't. They figured out ways to either keep some tenants in or sort of transition some of these properties, but those losses haven't necessarily been quote unquote written down or realized by these regional banks on their balance sheet yet. Now, here's the other thing I want to talk about quickly here as well. Powell does expect, as he said, that commercial real estate is going to cause some of the banks to collapse. The one thing you have to realize about that is that even if we start cutting rates, all of these buildings are valued based on what's called the income approach, where they're using the income that the properties are producing in order to get a valuation of the overall property. So rate cuts really aren't going to do a whole lot if the incomes of these properties that they're generating are low because nobody is in these office spaces. I hope that makes sense to everybody there because that is very important. Unless they can really transition the purposes of these buildings or start to get people back in the workplace, it's going to be very difficult for these regional banks to really get over this issue. Now, again, who's going to be the main beneficiary of all of this? Most likely the large banks, JP Morgan, Goldman Sachs, Bank of America, and banks like that. So this is mainly why Powell is saying that there's most likely going to be some regional banks that need to, or not need to, but are going to either be collapsing, closing their doors, restructuring, or doing something because all of this $1.2-ish trillion worth of losses in office space, and again, in other commercial real estate spaces as well, still need to be written down. Now, the other thing that I want to briefly touch upon before we go into what's going to be happening with interest rates in the near future, because I think this is incredibly important, we need to talk a little bit about the Fed's credibility. So let's see here. We have the U.S. economy doing the best of advanced economies. Powell, here it is right here. We are not far from confidence to cut rates. The main comments that we've seen from a lot of Fed speakers, but mainly Jerome Powell, has been they need to have more confidence that inflation is headed to their long-run target of 2%. Now, there's a lot of rumors right now that they might try and raise that long-run target. Again, conversation for another video. But if Powell is coming out and saying that they're not far from their confidence level to cut rates, well, then the overall market should be having a pretty good time, which, again, it is. But in terms of Fed credibility and people in large money players using what the Fed is saying in order to position themselves, having statements like this from Loretta Messer is really not helpful. If the economy meets forecast, rate cuts likely later this year, yeah, that's great. But they come out and they start saying all of these hawkish statements. Inflation may prove more persistent this year. Biggest mistake would be premature Fed rate cuts. Open question whether the neutral rate currently stands. There are a lot of different comments here. Fed's President Mester, January inflation reports were a wake-up call. Now, a lot of people and a lot of other Fed members are saying that the January inflation report were a fluke and due to seasonal factors and seasonal price hikes. Well, when Loretta Mester is coming out and saying, well, no, this is a wake-up call for the Fed, well, that's going to create a lot of potential uncertainty in the market. Now, it's really not an issue right now, but this is definitely something to watch out for going into basically March, April, and May, as a lot of investors are looking to see and are expecting that the Fed is going to start cutting rates in June. This is the Fed Watch tool right now. This is what I like to use to kind of get an overall understanding of what the market thinks is going to happen in terms of the federal funds rate going throughout the next couple of Fed meetings. And right now, you can see that the target rate is 525 to 550 basis points, which effectively means 5.25% to 5.5%. And there's a 56.9% probability, that's what market participants are giving this, that we're going to see a 25 basis point or 0.25% cut in June. Now, when we move on to July, it looks like we're going to be, they actually are pricing in a little bit more, 2 rate cuts here. So they're pricing in 41.3% probability that by the July meeting, we're going to have a target range between 475 and 500 basis points. Moving into September, you can see that we're right in that range as well. November of this year, we can see 450 to 475 with a little bit more of a normal distribution that we see here. Ooh, sorry, I'm going to make myself a little smaller so that you guys can see this here. A little bit more of a normal distribution that you guys can see. And then going into December here, what do we see? Well, again, that target range, the target rate range is going to be between 425 and about 450 basis points. Now, you might be asking yourselves at this point in the video, there are a lot of questions as to whether the Fed is actually going to be cutting rates this year, even though market participants are saying, yes, we think that the markets or the Fed is going to be cutting rates. And a lot of the key points that people are bringing up are, well, we are seeing some elements of CPI, PCE, and PPI remaining a little bit more sticky or hesitant to start coming down in making sure that our growth or our inflation rates in those types of assets or goods is actually coming back to that normal range. And what people are saying is, well, the Fed can't necessarily cut rates because all of these assets are so high. You're still seeing real estate prices so high. Even with these higher mortgage rates there, and people don't necessarily think that the Fed is going to be cutting rates. Now, all of these people, I think in general, are leaving out something incredibly important, and that has to do with the United States debt. When we come over here, this was an article from back in, I think, November of 2023. Yeah, November 2023. There's $7.6 trillion of United States debt that that is going to mature this year. And what the United States has to do is roll over this debt to different bonds that have more time to maturity. Now, when we think about how bonds work from the United States government, well, they're given an interest rate. Now, right now, interest rates are a little bit higher than they have been in the past. Does the United States government want to basically refinance $7.6 trillion of debt at higher rates? Well, the answer is obviously going to be no. That's why you hear me make jokes on stream all of the time that, oh my God, Janet Yellen must be calling Powell. Janet Yellen, the Secretary of the Treasury, kind of pressuring Powell to say, hey, it might be time to cut rates. So when we have to sell all of these bonds, the United States interest expense is going to be a lot lower. And that's why you're seeing Janet Yellen in this picture, in this video that we see down here. So that is an important factor too, everybody, that we have all of this debt we need to roll over. And the current environment is really not going to be good or beneficial to the United States government when they have to sell these bonds. Now, before we go, everybody, I want to go through what we have to look for going in tomorrow, Friday. Again, remember, we are going to be live streaming from 9 a.m., probably around until 10:30, 11 o'clock. We do that every single day. But tomorrow is a very, very big day. The reason why I'm making this video a little bit earlier today, again, it's about 1 o'clock here for me on the East Coast, is that the price action today, to me, really does not matter going into the afternoon. We have non-farm payrolls tomorrow morning at 8:30 a.m. U.S. non-farm payrolls, unemployment rate, hourly wages year over year. This is a giant report that comes out and almost always has a big influence on the market and can easily set the tone for where the market is going to go over the next couple of weeks here into the next FOMC meeting. And that is kind of why I've been telling you guys here too, that we have to look for these touch points and how this trend is actually looking. If this trend continues higher, again, all of us in the Swing Kings course, we're going to continue to be hitting those 500%, 1000% trades. And in the meantime, obviously using the day trading mastery course strategy that has had 14 winning months in a row, we're going to be able to keep taking advantage of a lot of these upside setups. But if that starts to switch, we're going to be taking a step back, playing a little bit more defensive and taking more setups to the downside, obviously. But we need to watch this trend in the overall market in order to make that decision. So guys, that's going to wrap it up for this video here. I hope you guys enjoyed this. I really like making these educational videos for you guys. So if you did enjoy, make sure you leave a like down below. Comment down below as well if you have any questions about anything we covered, and subscribe for more videos like this. Other than that, guys, I'll see you later. Peace.